A very good morning to all of you students. My name is C. Divas Gupta and today we will be discussing about the topic of interest rate risk management.
Good morning, sir.
Good morning. So student, this is a very interesting topic because this actually deals with some of the very useful products in the practical scenarios for banks and let's say the borrowers or lenders. And this is something that we cannot do away with. The interest rate risk in any of the company cannot be done away with. So this is something that is very much relevant from all the standpoint. So yes, interest rate risk management students, first of all, we need to understand that why is interest required to be paid or received on the borrowings or lending. So what is the genesis of interest? Would anyone want to share their thoughts? Why is interest actually levied? You can just put your answers in the chat box. For what all reasons do you think the interest would be levied? So whatever comes to your mind, you can just put it on the chat box. Okay, for the cost to be recovered for providing the facility. Okay, Sanjay, thank you. So, so basically, one, the with the efflux of time, money loses its value, right? Which is called as the time value of money, or we can say that 100 rupees today will not be the same. So the power of that 100 rupees today will not be the same power of that 100 rupees 1 year from now. So this is called as time value of money. So one, if I'm giving 100 rupees today, and if you repay me back 100 rupees after 1 year, would it be And would it be a fair deal? The answer is no, because today's 100 rupees is equal to, let's say, 105 rupees 1 year from now. So I need to get back not 100 plus 100 plus 5, which is 105. So that 5 rupees represents interest, which is time value of money. This is also called as inflation. I mean, some part of it is due to inflation. So we can also understand it from the perspective of a fruit basket, right? Let's say, or not fruit basket, but a standard goods basket. A standard goods basket today, if it costs X rupees, so it is not that after 1 year also it will cost you X rupees. It might cost you more than X, right? Depending on the inflation, right? So this is called as time value of money, for which we will be paying the interest. And the second part, the second part, students, is actually the risk of lending the money. So, risk of non-payment, where risk is high and interest expected will also be high. Where risk is low, interest expected will also be low, right? So let's say we give on let's say credit 1 lakh rupees to someone for 1 year. Now till 1 year, there is going to be a risk of non-payment of two things. One, the principal itself, and second, the interest as well. So there is a counterparty risk wherein the other party might not be able to repay the entire 1 lakh rupees along with the interest and the principal amount. So because of this risk, there is a additional premium that we charge, right? So let's say the time value of money or inflation was 5%, but due to the credit worthiness of the person who has borrowed the money, we feel that another 2% should be added for the risk part. So in totality, we will be charging 7% for the loan that we have given. So this risk is actually dependent upon the specific to the parties, right? Which are actually underdoing this deal. Clear, students? And why does this risk arises? Because there is a possibility that the person who has taken the loan or taken the borrowings will not be able to repay. Okay, so that's the second reason due to which we pay interest. So these are the two broad reasons, students, due to which an interest is paid. So first of all, we have understood that why there is a need of an interest in the interest rate risk management. And as I was explaining, let's say today's 0th day, rupees 100 will become rupees 105, let's say maybe after 1 year. So there is a 5% inflation, students. So there is a 5% inflation, which is actually representing time value of money, right? Now, one more thing, students. Now, all of you should answer this. Interest rates are static or let's say fixed, or they are dynamic. That means they keep on changing. So if I talk about, let's say, the market interest rates, are they always be fixed? Let's say, are they always 9%? Or they keep on changing, which is, let's say, today it is 9%, it might happen 9.5, it might happen 8.5, it will keep on changing, depend on the market scenario. Come on, students. Just put your responses in the chat box, whether it is static, fixed, or dynamic keeps on changing. What do you think? Yes, very good, Sanjay. Yes, Leela, you're right. So, yes, you are right. So, it will keep on changing. It is never static. It is just like the prices of the share markets, which will actually keep on changing. It will depend on the demand and supply. It will depend on the fundamentals of the company, right? It will depend on a lot of things. So, since interest rates are bound to change, there is a need. So, first of all, it leads to interest rate risk, students, right? So, whatever is changing, it will lead to different outcomes in future, right? And hence, it will lead to interest rate risk. And interest rate risk, please make a note of it, students. This is very, very important. This is the real reason why this topic we are studying. So, interest rate risk. So, what is the risk? Risk is that the interest rate changes. Now, It can change into the opposite direction. It can change into the same direction in which we expect. So it will lead to what? It will lead to impacting financials of the company. So it will impact the financials of the company. It will impact the profit and loss and the balance sheet part of the company. So how come? Let's say this is your P&L. Here you record income and here you record expense. So let's think about the interest income here, right? And interest expense here, right? So this will lead to what? This will lead to the interest and expense differences, right? Now let's say if the interest rate increases, so the income will also increase, and let's say the expense will also increase. So what will happen now, students? The shape and form of the P&L will change. Let's say your borrowings were at a fixed rate of interest, but your interest income is floating depending on the market situation. So if the interest income goes down, the interest rate goes down, the interest income will go down, but the interest expense will keep on be flat. So this will lead to your impact in the overall P&L of the company as well. So different scenarios will lead to different impacts into the P&L of the company, students. So to avoid this or to manage this, right, the concept of interest rate risk management is there, wherein now we are managing this risk. How should we mitigate the impact of such risk? This is called as hedging interest rate risk. This is about hedging the interest rate risk. So there are two different methods. One is traditional method and second is modern method. So students, traditional method is basically divided into two parts. One is asset and liability method, which is also called as ALM, and forward rate agreement, which is called as FRA. These ones, modern methods, are split into three different parts. Interest rate futures, interest rate guarantees, then interest rate swaps. All of them are very interesting methods. Each one of them is very much unique and very much interesting. So we'll go with the sequence. One, two, then third one is this. fourth one, and fifth one. Along with that, we will solve the practical problems as well. So the first one, asset and liability method. So students, if I may ask you that why does the need of a borrowing or a investment of surplus cash arises? Let's think about a company, right? A company has a need to borrow or has a need to invest. Why will it arise? It will arise because of a simple reason that in case of a borrowing, you are realizing your asset after you are due to pay your liability, right? Because that is why you will have to borrow and pay the liability, and then later on, once you realize your asset, then you will repay back the loan, correct? So that means your realization of asset is ahead of the payment of liability. The second case, why there is a need to invest? There is a need to invest because you're realizing your assets first, but your due date to pay your liability is in future, right? So, in a way, you will have to enter into these situations for borrowing or investing, which will lead to the differences in the interest rates, which will also impact your interest income or interest expense, right? So, in the asset and liability method, students, what we are doing is we are trying to eliminate itself the need to borrow or invest. How can this be done? By matching the maturity of a liability with the maturity of the asset. Okay. So, to the extent possible, can you match your, let's say, maturity of the liability to the maturity of the asset so that the asset is realized, liability is paid off? There is no need to invest the surplus amount or borrow the deficit amount. Timing of cash inflows and cash outflows, matching the asset maturity with the liability maturity. Right? So this is the first method, and this is a very famous method in case of a banks, in case of NBFCs, where they are even tracking the maturities of their assets and liabilities, and hence they also report to the RBI that what is their ALM number. So there are different returns to it. Okay. So the second part now, let's come to the second part. So asset and liability, there is nothing much. It's just about the conceptual clarity. Now let's come to the forward rate agreements. Yes. Now forward rate agreement, students, let's understand with the help of an example. There are two banks, Bank A, Bank B. Now Bank A needs to borrow the amount, but not today. After some time, let's say in future, Bank A needs to borrow. Let's say due to this ALM method, the bank has been able to match 90% of its liabilities and assets, but only 10% of the assets and liabilities are not matching, and hence they need to borrow after 1 month. So, bank A needs to borrow after 1 month for 3 months an amount of rupees 1 lakh. So the duration of borrowing will be 3 months, but the borrowing will happen not now, 1 month from now. Similarly, bank B needs to invest after 1 month for 3 months rupees 1 lakh. Clear situation, students? So the situation is that bank A needs to borrow and bank B needs to invest, but both of them will have to do it after 1 month and for a period of 3 months, and the amount is exactly same. Now they both know that the current interest rate is, let's say, 5% per annum. So do you think that both of them will be okay to deal at 5% per annum? The answer is no. Why? Because this is today's rate. You don't know that what is going to be the 1 month from now, what is going to be the rate. So hence they will come out with a forward interest rate, which is, let's say, 6% per annum. And this is 1 month forward interest rate. Yeah. Okay. Now, what will happen? The In case they want to commit to both of them, let's say bank A commits to bank B that I will borrow after 1 month for 3 months of rupees 1 lakh from you at the rate of 6% per annum, and bank B commits to bank A that I will invest or I will lend you rupees 1 lakh after 1 month for 3 months at the rate of 6% per annum. So that commitment is also shared. So this will lead to the locking of the interest rate at the rate of 6% for the respective deals that they are going to do. So in a way, from 0 to 1 month, the let's say on the 0th day, the deal is entered and it will be executed after 1 month, will continue for 3 months. Duration is equal to 3 months. So that means for the fourth month, the deal will get over. This is the first month and that is the fourth month. Sorry. Okay. So this is called or denoted as FRA 1 by 4. This is the standard language that is used. So FRA, means forward rate agreement, And 1 by 4 means after 1 month, the deal will execute and the duration is 4 minus 1. 3 months is going to be the duration, students. Clear? Now, if I say there is a FRA of 3 by 6, starting point will be third month from now and duration will be 6 minus 3 is equal to 3 months. Similarly, if FRA 12 by 18 is there, students. Yes, very good, Sanjay. If let's say FRA is 12 by 18, then starting point will be, yes, you're right, Sanjay. The answer is correct. So the starting point will be 12th month, which is after 1 year. And here the duration of the loan giving or taking is how much? 18 minus 12 is equal to 6 months. So after 1 year or after 12 months, the actual loan given or taken will be there and the duration of that will be for the period of 6 months. I hope this is clear. The notations are clear. What exactly do we use here? So students, I hope it is clear that it's not a normal lending or borrowing arrangement, right? Because in that you will lend or borrow as on today. Here the lending or borrowing is not happening as on today. Okay, now let's come to the impact analysis of entering into this deal. Again, there were two banks, Bank A and Bank B. They have entered into a forward rate agreement of 1 by 4 for 6%. So 0th period, nothing will happen. After first month, okay, which is 1 by 4 when the deal is executing, at that point of time, let's say there are different cases, students. Let's say the case 1 where the actual interest is 8%. Where the actual interest rate is 8%. Now what will happen, students? Now if you think from the perspective of Bank A, now Bank A through this deal have a borrowing to be done at 6%, but the market interest rate is 8%. So do you think Bank A is at a gain or is at a loss? Bank A is at a gain. Why? Because had Bank A not entered into this agreement of FRA, the Bank A would have been taking the borrowing from market today on 8%, which is 2% higher than the rate at which this FRA is giving the bank a benefit. Right? So the person, or let's say the bank who is into the borrowing position will actually gain by 2%. Now, if we talk about Bank B, the Bank B has to invest or has to lend the money. Now, while lending the money, had Bank B not entered into this arrangement, Bank B would have been lended at 8%. But now, because of this arrangement, Bank B will have to lend at 6%. So there is a 2% shortfall in the income that Bank B will have compared to the market reality, right? So here there will be a loss of 2%, right? So the loss of 2% will be basically representing that had Bank B not entered into this, and Bank B would have gone and seen directly the open market rate, then there would have been a better interest outcome. Now, students, some of you might be feeling that, let's say, if the situation is to borrow or lend after 1 month from now, banks can simply just do that after 1 month from now. Why are they entering into a deal as on today? Right? Some of you might have this question. Now, now why banks would want to enter into these arrangements is to fix their interest obligations, or let's say their interest earnings. The reason is, if they are not fixing it, then it can turn out to be even, let's say, very high number or a very small number. So in a way they are trying to fix the outcome that is going to happen, right? That is why it is called as hedging, that we know that at what level we should hedge, right? Now case 2, let's say after 1 month the actual rate has fallen down to 5.5% students. In this case, if you see, the bank B is committed to lend at 6%. However, the open market rate is 5.5%. So there would be a gain of 0.5% to Bank B. Why? Because Bank B has entered into this deal and Bank B will be lending at 6%, which is 0.5% higher than the market rates. Clear? Now, for case 2, from Bank A's perspective, now had 5.5% been not there in the, sorry, had 6% deal not there in the market, Bank A would have borrowed the money at 5.5%. So that means there is a 0.5% loss that has been accumulated. Right? Now, if you see, students, if the if we talk from the borrower's perspective, let's say the person or the bank who is into the borrowing situation, that borrowing situation bank will gain if the market rate goes up, and it will lose if the market rate goes down compared to the FRA price. Similarly, if we talk from bank B's perspective, which is a lending bank, so here what will happen? Here, the if the interest rate goes up from the lending side, the bank will lose. If the interest rate goes down from the lending side, bank will gain because of this agreement in place, right? So we're talking about only where this had this agreement not been there and had this agreement been there. Simple, right? Now, if you see this gain or loss, there are two ways to settle it. Okay, just like in a forwards or in a future, there are two ways to settle it, right? One, we will settle in net, and second, we will settle in gross. By settling in gross means that the actual delivery of the shares will happen and the actual payment will also happen. So the gross settlement of the bank loan will be what? The gross settlement of bank loan will be that bank B will lend 1 lakh rupees and bank A will keep on paying 6% to bank B. Clear? So this is the gross settlement. Now, in case you're talking about the net settlement, so the net settlement will be the differential amount will be paid out. How? Let's talk about case 1, right? So, bank A would get 2% and bank B would pay 2%. For example, 1 lakh rupees multiplied by 8% minus 6%. This is the differential. But this we said will operate for only 3 months. Whole divided by 1 plus 8% into 3 by 12. Present value at the start of loan, right? So this will help us in coming to the present value at the start of. If let me not do this, otherwise it might create a confusion. So this is basically present value at the start of loan. So if you see, the numerator is actually representing the gain or loss, right? Which is the 2% amount. And the denominator is done because this will be due after 4th month from now. So what will be the amount due after 1 month from now, right? Which is here. Yes, here. So standing here, we will do the calculation, students. Correct? So at this point of time, what is the 3rd month present value for the differential payout needs to be calculated. Okay. So this comes out to be 490.19. So bank A would get 2% and bank B would pay 2%. That means bank A would get 490.19 and bank B would pay 490.19. Case 2, students. Bank A will pay 0.5%. Bank B will receive 0.5%. Right, students? So now how this will be calculated again? 1 lakh multiplied by 6% minus 5.5% into 3 by 12. So this is the differential of the gain or loss, right? For 3 months. Whole divided by 1 plus 5.5% into 3 by 12. So always remember, students, what we are doing, we are taking the present value basis the exact rate. Present value to be taken basis actual rate. The reason is because on actual rate itself, the present value will be done. So this comes out to be 123.31. So here Bank A would pay 123.31 to Bank B, right? And students, now this gives us the formula for the payoffs. N multiplied by RR minus FR multiplied by T whole divided by 1 plus RR into T. So here N represents the notional amount. Let's say the principal amount. Right? So it represents the principal amount. RR represents the actual interest rate. FR represents the forward rate at which the deal has been entered into. Okay? And T represents the time period, which is actually the duration. Okay? Now, if we summarize this discussion till now, what we did, Bank A, which is into the borrowing position, Bank B, which is into the lending position. So, Bank A purchased FRA, into the long position, and Bank B is actually called to be said as sold FRA, which is the short position. So one is selling the FRA means into the lending position. Buying FRA means into the borrowing position, students. Now let's also think through this. If the interest rate goes up, the bank A, which is into the purchasing FRA, will gain or lose? It will gain. If the interest rate goes down, this will also go down. The gain will also go down because it's just like you are having a long position in any of your forwards, right? So what used to happen in any of your forwards? Let's say a forward for X limited share price. You have a long position. The share price goes up, you will gain. The share price goes down, you will lose. Similarly, if the interest rate goes up, the purchasing FRA position or the borrowing position will gain. If the interest rate goes down, the purchasing FRA position or let's say the borrowing position will also lose or their gain will come down. Clear? Then here, if the interest goes up, then the gain will come down. Interest rate goes down, then gain will go up. It is similar to the selling of the forward. While in selling of the forward, if the prices comes down, then you will gain. If the prices goes up, then you will lose. So similarly, instead of the prices here, we have the interest rates. In case of a selling FRA position, or let's say a lending position, if the interest rate is up, the gain will come down. If the interest rate is down, the gain will go up. Clear? So now students, let's come to the question number 1. Perfect. So let's come to the question number 1. Ankush Limited has a plan to raise an amount of 50 crores for a period of 3 months, 6 months from now. Can we say this is which FRA? Come on, students, tell me. Please write on the chat box. This is FRA denoted by what and what? FRA dash into dash. Please fill. 3 months is the period and 6 months from now. So it will be FRA what and what? Yes. No, Leela. This is no, Sanjay, again. Just check once. So 6 months from now is the starting point. So the first one is actually the starting point. Bibu again, no. So what they are saying, okay, let's always put it like this. Today is 0. After 6 months, the the amount has to be raised for 3 months. So the duration is 3 months. Yes, Bibu, you are right. Sanjay, you are also right. No, again, you are not right. It will not be that. Again, think through. We are making one more mistake. So after 6 months, it will start for 3 months. Yes, Leela, now it is correct. So if it starts after 6 months, so the starting point will be 6. Duration is 3. So that means 6 plus 3 is equal to 9, and 9 is where it will end. So it denotes the starting point and the ending point. So it is 6 by 9, students. Clear? So this is FRA 6 by 9. Now one more example. Let's say after 12 months, the duration will be for 7 months. Now tell me, students, what is the FRA here? So here the situation is after 12 months it will start. Yes, very good, Sanjay. FRA 12 into 12 plus 7, which is 19. Yes, Leela, you are also correct. Bibu, you are also correct. Now everyone is correct. Very good. So this is clear now. Now let's come back. The current rate of interest is 9%, but it may rise in 6 months' time. That is the time in which they will have to borrow. The company wants to hedge. Please see this wordings. Hedge means they want to protect itself against the increase in the interest rate. Bank of India has quoted a forward rate agreement at 9.1% per annum. Okay, the FRA has been quoted at 9.1% per annum. Find the effect of FRA and actual interest cost to Ankush Limited. If the actual interest rate after 6 months happens to be 9.5 or 8.5, so they have given you two different cases, either 9.5 or 8.5%. So there are two different cases after 6 months. Now we'll have to calculate how is the forward rate agreement doing here. Perfect. Now let's start the solution. So this is FRA 6 by 9, 9.1%, right? This is the FRA. Now case 1. Actual interest is 9.5%. If the actual interest rate is higher, the person who is into the borrowing position will be benefited, right? Payoffs will be in the same formula, right? That we discussed, minus FR into T divided by 1 plus RR into T, which is actually 50 crores multiplied by 9.5% minus 9.1% into 3 by 12 whole divided by 1 plus 9.5% multiplied by 3 by 12. So this is the amount that will be paid or received after 6 months from now, right? And the duration is 3 months, and hence the overall amount comes out to be rupees 488,400 as the gain. Now, impact to Ankush Limited. What will be the impact to Ankush Limited, right? We'll have to find out the real impact. So, this is due to the FRA that there is a gain. Now, there is an interest payment at the rate of 9.5% for 50 crores, right? So, it will be 9.5% into 50 crores into 3 by 12. So this is 1 crore 18 lakh 75,000, right? Minus gain on account of FRA, which is 488 400, 1 crore 13 lakh 86,600. Effective borrowing cost 113,86,600 divided by 50 crores into 12 by 3, right? Which is to calculate the annualized rate, students. So that is why we have done 12 by 3. So this comes out to be 9.1092 to 8% students. So this is approx 9.10%, which was the FRA situation of 6 by 9. Clear? The actual interest is 8.5%. Then what will happen? Then the payoffs will still be calculated as same 50 crores multiplied by 8.5% minus FRA rate 3 by 12 divided by 1 plus 8.5% into 3 by 12. So this is going to be a loss, right? Because Ankush Limited is into the borrowing position. The rate of interest has gone down from 9.1 to 8.5, right? So it will be a loss. 734, 394. This is going to be the loss. Impact on Ankush Limited. Interest would have been paid at the rate of 8.5%, which is 1062 5,000, right? Which is actually 8.5% into 50 crores multiplied by 3 by 12 plus payoffs for FRA 734 394. Total interest cost. So this was a loss and hence we have added it here, students, right? So that it will add up to the amount what they are be paying. 113,59394. So the effective borrowing cost will be 113,59394 divided by 50 crores multiplied by 12 divided by 3, which is 9.0875%, or we can call it as 9.1%, which is FRA of 6 by 9. So in both the cases, if you see, the cost is logged at 9.1%. So this is the concept of hedging, students, right? So the hedging, it says that it will have to be at the defined outcome. Here the defined outcome is for FRA 6 by 9, you will end up paying 9.1%. So if you are settling on a net basis, still your final outcome will be basis the 9.1%, students. Any questions or any queries till now, students, please do let me know. Yeah, sorry. Let's move ahead. Okay, now let's come to the concept of valuation of FRA. I'm sorry, let's take an example of FRA 3 by 6. Okay, let's take this example of FRA of 3 by 6. So 3 by 6, let's again draw this 0th month, third month, and then duration will also be 3 months. Sorry. So after 6 months, right? So students, if you see in the market, right, there are different interest rates available for different types of maturities. Okay, let me write it like this. Different interest rates available for different maturities. For example, 3 months interest rate, let's say, would be 4% per annum. Similarly, 6 months interest rate will be, let's say, 5% per annum. Similarly, 9 months interest rate would be 5.5% per annum. As you increase the maturity, the rate of interest also increases. Similarly, let's say 1 year, it will be 6% per annum. 10 years, let's say it will be 7.5% per annum. And these are just hypothetical numbers. But what I'm trying to say is that in market, different maturities will be available, and against those different maturities, the per annum rate would also be different. Okay. So here we will take two maturities. One is till the starting point and till the ending point. Starting point, and second one is till the ending point, right? So here 6 months is effectively 5% per annum. And here 3 months is effectively 4% per annum. Now, if you know what is the interest rate for 6 months and what is the interest rate for 3 months, then can we calculate that what is this period? The answer is yes, we can calculate. For third month to 6 month, can we calculate what is the differential interest rate going to be? The answer is yes, we can do that. Sanjeev, you're asking, we are calculating the interest for the FRA for FRA period. Yes, that is right. In the formula, if you see this one, we are multiplying only for the FRA duration here, right? This is FRA duration, and hence we are calculating the numbers only for the FRA period, students. Okay. Yes. So I was saying, can we calculate the differential period rate? Yes, we can calculate. How? Using this formula. 1 plus 5 percentage for 6 months. right, is equal to, so this is the total interest rate for 6 months, will be equal to 1 plus 4% for 3 months multiplied by another 3 months, let's assume to be X percentage. Clear? So what we are doing is we are saying that if you reach through two different channels, one, you reach directly from 0 to 6 month using 5% per annum, or you just first go from 0 to third month at this interval and again from third to 6 months with another interval, then your interest rate of X percent will be from third to sixth month, which is FRA 3 by 6. Clear? So here X is actually going to be 5.94 percentage, which is called as the theoretical minimum value. Right? So here from third to sixth month, it comes out to be 5.94 percentage, right? So this is the theoretical minimum value. Now let's take what to do with this. Case 1, FRA is available at lower than 5.94 percentage. That means FRA is underpriced. Now students, if anything is underpriced, what do you do? If anything is underpriced, you buy it. If anything is overpriced, you will sell it. So if FRA is underpriced, now what you will do is we will take a long position in FRA. Long position in FRA. That means borrow through FRA. Now, if you are borrowing through FRA, then because this is a strategy that we are devising, then what will you do? Okay. So 0, 3 months and 6 months, right? So as we said that there are two ways to reach there. One is directly for the 6 months. Second one is through an interval of 3 months, right? Now, here we are saying that using the FRA, we will borrow. We will take a long position because the FRA price is lower than 5.94%. So if you are borrowing in third to 6 month, in 0 to 3 months also, you will borrow. So we will do actual borrowing. And what you do after borrowing here, you will actually invest for 6 months. So you will invest for 6 months by borrowing from 0 to third period and third to sixth period, right? So effectively what you will do, you will borrow for 3 months, FRA 3 by 6, and invest for 6 months, right? So this is one, this is one, this is two, this is 2, and this is 3. This is step 3. So effectively, what will happen? Your your investment that you did here will give you higher amount, and borrowing you'll have to pay lower amount. You will be able to save something which is called as the arbitrage gain. This is your arbitrage gain, right? Which is the riskless profit. Why will arbitrage gain occur? Because the FRA was lower than the theoretical minimum value. Now it can be demonstrated using like this. We said that you will borrow first for 3 months, right? Let's say you borrowed 1 lakh rupees, and then you invested this 1 lakh rupees, invested 1 lakh rupees for 6 months. Overall, you will get 1,07,000. On maturity, you will get 1,03,000. And this 1,03,000, after 3 months maturity, you will have to invest through buy through FRA 3 by 6. Here it will be borrowing 2. But please do remember, this FRA will be entered for 1,03,000, right? And on maturity, you will end up paying 1,06,000. Again, this is just an hypothetical figure. Maturity of FRA. Let's say the gross amount that comes out to be is 1,06,000. So ultimately, you will have a arbitrage gain of 1,000 rupees. How it has come, students? Because one, you will invest at this designated price, right? You will invest at the designated price of 1,07,000, and in maturity of the borrowing, you will end up paying 1,06,000. How have you arrived at this? 1,06,000 is coming from 1,03,000 of FRA. Okay, so please don't get confused. FRA, we will settle net. But you remember, we have checked in the previous question, we have checked at a gross level what is the total value coming out to be of the loan, right? So, similar way, this will also be there. And this is the actual borrowing itself, correct? 1 lakh leading to 1,03,000. Okay. And why is this all happening? Because our FRA was underpriced. FRA was underpriced, hence we took a long position, and hence we are able to make a arbitrage gain. Clear, students? Now let's come to case number 2. Where FRA 3 by 6 is overpriced, higher than 5.94%. 5.94 was our theoretical minimum price. Now, if FRA is overpriced, then what will happen? They will start. The idea is to short sell this FRA. That means you will be selling the FRA. That means you will be investing through FRA. Overpriced. That means you will short sell FRA. lending position, invest through FRA. Clear? Again, 0 to 6 months. This is the third month and this is the 6 months. So here we are investing. Here also we will invest. And now here we will borrow. So 6 months we will borrow. 3 months we will invest. Another 3 months through FRA we will invest. Borrow 6 months. Investment 1 for 3 months. Investment another investment for 3/6 by selling FRA, which is the lending part. Clear? Then comes gross and net. Okay, so gross means that the actual borrowing or lending at the rates which are specified in FRA, right? So gross settlement means that you are actually lending or actually investing at the rates which are specified in the FRA. In terms of net, pay or receive net. So this is the formula, right? What is the net gain or net loss on account of which the net amounts are calculated, students? Clear? So now the valuation of the FRA is also clear, students. So let's quickly revise what we have done till now and then we can move ahead. So students, first of all, in interest rate risk management, we discussed that why is the interest paid? Interest is paid for two reasons. One, time value of money, which is inflation. Second, risk of non-payment, right? Because there is a risk involved of the counterparty. Hence, there is a compensation in the form of a risk. Now, because interest rates are dynamic, it keeps on changing, it leads to the interest rate risk. Interest rate risk will impact the financials of the company because if your interest income and interest expense are on different bases, it will lead to the differences in recording of the P&L impact. Now, how to hedge the interest rate risk, students, we discussed. There are two broad methods, one traditional and second modern method. Under traditional method, we studied about asset and liability method, forward rate agreement, and in modern method, we are going to study about the interest rate futures, interest rate guarantees, and interest rate swaps. Asset and liability method, it was very simple, wherein you need to match the maturity profile of your liability with the asset or your assets maturity with your liabilities maturity so that the need to invest or need to borrow becomes bare minimum. Forward date agreement, students. Forward rate agreements is basically an arrangement where you will lend or you will borrow, right? Not today, but 1 month from now. Or let's say whatever is the specified period from now. After that period, you will lend or borrow. In our example, we have taken 1 month. Now, it is denoted by FRA starting point multiplied by ending point, right? So starting point will be when the deal will get executed, and ending point will be starting point plus duration, right? Now here, an important point to note is that whosoever is purchasing the FRA is into the position of long position and into the position of a borrower, right? So borrower is as good as purchasing the FRA is as good as long position. And if the interest rate goes up, their gain will also go up, just like we had studied in a regular derivatives. If the interest rate goes down, the gain will also go down. Similarly, for bank B, students, the bank B, which is into the lending position, they will be selling the FRA. That means it's a short position. If the interest rate goes up, the gain will go down. If the interest rate goes down, the gain will go up. So it's a reverse situation here. Then we discussed about how we can calculate the gain or loss, right, using the above formula. And finally, we discussed about the valuation of the FRA. Now, for valuation of FRA, we will have to take both the routes, right? The first route wherein we directly reach to the end point. The second route is in two intervals. First to the starting point, and then from the starting point again to the ending point, right? So from today till starting point will be the same position that we will do, that we are supposed to do for the FRA in the duration period. Okay. So using the different maturities interest rates, we will be able to arrive at that what is the next period differential period interest rate. Okay. So FRA is available at lower price at under, then you will, it's an underpriced. Basis that underpriced, you will take a decision to purchase the FRA. If you are purchasing the FRA, that means you are borrowing. If you are borrowing in FRA, that means in the starting period also you will borrow, and then ultimately for the entire period you will invest. Similarly, for the case 2 where you are investing through FRA, so in the 0 to third period also you will invest, and then overall for the 6 months you will borrow if in case it is overpriced. Okay, and then we discussed about the gross and net settlement, students. Yes, now let's come to the question number 2. Okay, this has a use of, I think, interest rate futures. Let's discuss quickly about interest rate futures as well, students. Interest rate futures, wherein bond prices are used against the interest rate futures. So what happens, students? Like we have futures of shares, like we have futures of commodities, right? We don't have futures of interest rates because how will you denote them? But there are futures of bond prices that are available. And we all know that the bond prices are inversely related to the interest rate changes. If the interest rate goes up, the bond prices will go down. And if the interest rate goes down, the bond prices will go up. So, in a nutshell, students, what we are saying here is for bond prices are inversely related to the interest rate changes, right? So, this effectively means that the interest rate, it goes up the bond prices will go down. If the interest rate goes down, the bond prices will go up. Right? So, can we make use of this relationship? If the interest rate is supposed to go up, so we have to devise a strategy through which we gain if the interest rate goes up. Correct? So that will happen how? By purchasing the bonds or by selling the bonds futures. It would happen by selling the bonds futures. Because if the interest rate goes up, the prices of the bonds will keep on coming down. And you will gain if the prices of the bonds will keep on coming down when you have short sold the futures. So what you will do, students, your bond futures, we are going to do a short sell. Interest rate goes down. In such a case, if the interest rate goes down, that means the bond futures or the bond prices will go up. If the bond prices or the bond futures are going up, that means you need to have a long position. Because if you have a long position, then only you will be able to gain. So this is the third method from modern methods listing. Now, students, please focus here. Let's clarify this so that we are not mistaken. So, students, first of all, interest rate futures are not available as a product in the market. Just like we discussed about the forward rate agreements. Forward rate agreements are very much available. These are over the counter contracts. But interest rate futures are not available directly. So we make use of the bond futures. And we know that the bond prices are actually inversely related to the interest rate changes. How? If the interest rate increases, the bond prices will decrease. And if the interest rate decreases, the bond prices will increase because they are inversely related. Now, for a moment, think that you are into a situation in which if the interest rate goes up, you will have to gain. Now, if the interest rate goes up, you can gain only when the bond will go down, right? If the bond prices also are going down, because the interest rate goes up, the bond prices will go down. If the bond prices are going down, that means you need to short sell the bond futures. The moment you short sell the bond futures, let's say you short sold at 100 rupees, and because of the interest rate going up, the bond futures prices comes down. Now it will be 90 rupees, for example. So you are able to gain 10 rupees, right? 100 you short sold, 10 you are gaining. Similarly, if the interest rate is supposed to go down, then you have to devise a strategy. If the interest rate goes down, you gain. How? If the interest rate goes down, you need to purchase a bond future, because the interest rate is going down, the bond prices will increase. The moment bond prices will increase, you need to have a long position to make the gain out of it. How will you make the gain out of it? You will purchase the bond at 100. Now the price of that bond future has turned out to be 110. Why 110? Because the interest rate has gone down. The moment it becomes 110, it will be sold, for example. So there will be a 10 rupees gain of 110 minus 100. So that will also give you a benefit. So if the interest rate goes down, bond futures needs to have a long position. If the interest rate goes up, the bond futures needs to have a short position, students. Okay. Clear? Any questions till now, students? Any doubt, any question, any query? Please do let me know. Let me check the other query handle as well. So, so this is all about the bonds futures, the interest rate futures. So, students, let's take a quick break of 10-12 minutes and then again reconvene. Thank you. Let's come to question number 2. Electrospace is a consumer electronics wholesaler. The business of the firm is highly seasonal in nature. In 6 months of a year, the firm has a huge cash deposits, and especially near Christmas time and other 6 months, firm crash crunch, leading to borrowing of money to cover up its exposure for running of the business. Okay, it is expected that firm shall borrow a sum of 50 million euros for the entire period of the slack season. Slack season means the 6 months in which there is no good amount of sales happening. That means the 6 months of cash crunch in about 3 months. So they are saying that in about 3 months, the slack season is coming. That means the bad period, or let's say the non seasonal period is coming. A bank has given the following quotations: spot 3 by 6, 3 by 9. And these are the rates at which you can invest through FRA. These are the lower rates. And these are the rates at which you can borrow through FRA. Because bank will keep the spread, bank will charge you a higher amount on borrowing and will give you lower amount on lending. So first of all, students, tell me, the borrowing is going to happen after 3 months for 6 months of period. So this is a FRA of what and what? Come on, students. Please do respond. This is FRA of what by what? After 3 months, the slack season is going to come for 6 months, and that is when they need the cash. Yes, very good, Sanjay. Starting point and ending point. So the starting point is when? After 3 months, and ending point is 3 months from now plus 6 months of duration, which is 3 by 9. So this is a question of 3 by 9. Now let's move ahead. 3 month 50,000 euros future contract maturing in a period of 3 months is quoted at 94.15. So students, as we discussed, this is a bonds future, correct? So 5.85 is basically 100 minus 5.85 will give you 94.15. So this is a way to represent that 94.15. Either you say 94.15 is the price of the bond, or 5.85 is the discount rate at which this bond is quoted. You are required to determine how a FRA shall be useful if the actual interest rate after 3 months turns out to be 4.5 or 6.5. So they are asking us whether it is be how it is will be useful if the actual interest rate is 4.5 and a 6.5. So first, for the FRA, we have to determine that which FRA is actually relevant here and what is the rate at which the FRA would be entered into. Basis facts given in the question. Electra space needs to borrow 50 million euros through FRA three by nine at the rate of 5.94%. Calculation of gain slash loss. 4.5% and 6.5%. Right? So this is clear, first of all, students. 3 by 9 is what we have already discussed, and 5.94 is why? Because we are borrowing. So you will borrow at 5.94 and you will lend at 5.64. So you are going to purchase FRA at 5.94 percentage here and 5.94 percentage here as well. 5.94 minus 4.5%, and here it is 6.5% minus 5.94%. So these are the differentials that we are talking about, right? So if I've entered at a FRA, if I've purchased the FRA at 5.94%, the actual interest rate goes down to 4.5, I will be at a loss. Correct? Because now the interest rate in which the market is dealing with has gone down. I could have borrowed at a lower amount of 4.5%, but because of this arrangement, I will have to borrow at 5.94%. So I'm making a loss of 1.44%. Then here, the market rate has gone up to 6.5%. I have an arrangement to purchase or to borrow at 5.94%. So that means I will be gaining to the extent of 0.56% because I can borrow at a lower amount operating in the market. Here it will be a gain. So we're talking about FRA payment here, which is almost 3,60,000 and 1,40,000. $1.44 into 50 into 6 by 12, 0.56% into 50 into 6 by 12. So the interest payment right? So the interest payment in both the cases will be basis the actual interest rate. So we are trying to calculate that what is the overall differential here. Here it is 6.5% into 50 million into 6 by 12. 11,25,000 and 16,25,000. So since this is a loss, this will get added to 11,25,000 and it will be 14,85,000. This is a gain. This will get reduced from the overall payment of 16,25,000. So this will become 14,85,000 again. By entering into FRA, the rate of 5.94% is actually committed, and using the above in different scenarios also, we are getting the similar amount, right? 14 lakh 85,000 divided by 50 lakhs into 12 by 6. So which is actually 5.94 percentage. So A part is clear. So the effective borrowing will happen at 5.94% and it will be useful because the rate is fixed. So we can just conclude this by saying we have already mentioned that FRA is useful to fix the interest rate obligations at 5.94% irrespective of the actual rate operating in the market. Clear? So A part is done, students. And now B part. How 3 months futures contract shall be used for the company if the interest rate turns out as mentioned in part A above. Now they're asking us to calculate basis the 3 months futures. Now students, we will have to use the inverse proportion or inverse relationship of the interest rates and the bonds futures. How can we do that? So first of all, here we will have to borrow for 6 months, but futures are available only for 3 months. That means if we have to hedge the 6 months borrowing, we will have to take 3 months into 2 times, right? Clear? So we'll have to take 2 times. Now, to achieve the hedging against the interest rate increase, let us just mention to achieve hedging against interest rate increase, the bonds futures needs to be short sold. Clear? Because if the interest rate increases, the bond prices will decrease, and you will gain in case the bond prices decreases. When? If you are short selling the bonds futures. Okay. So here you have 4.5%. Here you have 6.5%. Right? These are the two different cases. First of all, you will be selling futures at the rate of 94.15 and here also 94.15. How many number of contracts? So don't remember, we'll have to please do remember, we'll have to multiply by 2, right? So 50 million euros divided by 50,000 into 2, or we can say 6 by 3 as well, just to denote the number of months differential. So this comes out as 2000 contracts. Now the second part will be price of futures. This will be 95 point. So the first one was 4.5. So 100 minus 4.5 will be 95.50, and it will be 100 minus 6.5. So this is 93.50. This is price of the futures. Then third, gain slash loss. So here, since we have sold the futures, short selling futures, right? We have done the short selling of the futures at 94.15. The price have increased to 95.5. So that means there will be a loss. Correct? There will be a loss of how much? 0.85, 1.35. There will be a loss of 1.35. And here you have short sold the futures at 94.15. Your current rate is 93.5. It has come down. The moment it has come down, you have short sold the futures, you will gain. Gain how much? 0.65, the differential between both of them. There will be a gain. Okay. Then what about cash settlement? How will it happen? So for 1.35 multiplied by 50,000 is the lot size, 2,000 is the contract for 3 by 12 period. The number of contracts is 2,000 and 3 by 12 is basically the time period. So it will lead to 3,37,500 of loss. Zero 0.65 into 2,000 into 50,000 into 3 by 12. 1,62,500. There will be a gain. Okay. Then comes the regular interest on borrowings. Again, the same number, students, that we have taken in A above, 1125 and 1625. So here there is a loss, it will get added 337,500 plus 1125. So this is 1462,500. 11,25,000 and 337,500. Here it will be 16,25,000 minus 162,500, which is the gain. This one. So from the overall cost, we are reducing the gain. So this also comes out to be 14,62,500. The effective borrowing rate will be 14,62,500 divided by 50 million, which is the notional amount. Again 12 by 6. Right? So this will give us 5.85 percentage, which is the price at which entered into the futures. So 5.85% is the effective borrowing cost which was certain at the point of entering futures contract. Clear? So in a way, if you see in this question, it had two parts, right? One, to make use of the interest rate forwards, the forward rate agreements, and the second one was the interest rate futures. So both of them, the effective borrowing cost has been resulted into the price, or let's say the interest rate at which we have entered into these arrangements. 5.94 is what we have entered into for the FRA, and 5.85 is what we have entered into for the futures contract. And if you see, effectively, we are also ending up to those ranges in terms of our actual interest outflow. Okay. Now, let's come to interest rate options slash guarantee. I hope the things are clear, students, till now. Any queries or anything, any question, please do ask. Let's come to the fourth part now, which is the interest rate options or guarantee. Okay. There are two parts to it. Let's discuss one by one. The first one is a cap option. Cap option, students. Okay. And that contract is conveying you a right, a privilege, but not an obligation. Okay. It's not a commitment to always do the thing which is mentioned in the contract. It's just an option. In case the person who is holding A wants to do, that person will do, otherwise the person will not do. Now, to do what? To borrow, right? To borrow what? A specified amount, right? Notional amount. So a cap option is an option. It gives a right to borrow a specified amount, which is called as a notional amount, at a specified interest rate. That means the interest rate is also defined. That means here the interest rate is also defined on a specified date. Okay, so it is a contract which is conveying you the right to borrow a specified amount at a specified interest rate on a specified date. So, just like call option, this is a cap option. Call option used to give a right to buy a specified underlying at a specified price on a specified date or up to a specified date, right? Depending upon European or American option. So here the right, or let's say the option, is to borrow a specified amount at a specified interest rate on a specified date. Now, just like call option, this will also have a holder and a seller. You have a buyer, you have a holder, and you have a borrower as well. Then similarly, here you have a seller, or we call it as investor. So these are the two different names, students, right? So first of all, the person who has purchased the cap option becomes the buyer. We also call that person as a holder, and that person is into the borrowing position because that person wants to borrow. Similarly, the seller of the cap option is the investor, is into the investing position, right? B is actually floor options, students. So in case of a floor option, there is again, let's take an example of A, which is a contract, which is a right or privilege, but it's not an obligation. Why I'm trying to say it in different ways is that in a interest rate forward, or let's say futures, the forward rate agreements or interest rate futures, you are obliged to execute even if it is favorable to you or even if it is unfavorable to you. But in case of an option, you can only exercise if it is favorable to you. You can decide to do nothing if it is unfavorable to you. And for purchasing an option, we already know that there is a payment of premium that we do, just like insurance companies. We are buying some protection from the insurance companies. Similarly, here as well, we are buying a protection from the option sellers, right? So that we have a right to invest or to borrow. So in case of a floor option, students, now here the right is to invest. The right is to invest a specified amount which is again a notional amount at a specified interest rate on a specified date. That is called as floor option. Okay, again, there is a holder, buyer, but in this case now it is in the position of investor, right? In case of a cap option, the buyer or holder was in the position of borrower. Here it is in the case of investor, right? Because the right to invest, and the seller of floor option is in the nature of borrower, right? Because tomorrow, if there is a right to invest, the borrower will take a position to borrow. right? Clear, students? So now, if you see in derivatives, we have discussed about call option and put option. So call option is as good as cap option in case of interest rate options, and put option is as good as floor options in case of interest rate risk management. Clear? Now, these rights will not be sold for free. These rights will be sold for premium. Right? So the premium is the consideration charged for selling these rights. And this will be there for both cap or floor. Even for the cap option, even for the floor option, the premium will be paid. And these are paid by the buyers and received by the seller. Okay. So in case of a cap option, the buyer becomes borrower. In case of a floor option, the buyer becomes lender, or let's say investor, by whatever name we want to call. Let's call it as investor. In case of a cap option, the seller of the cap option becomes a investor. In case of a floor option, the seller of the floor option becomes the borrower. Clear, students? Any questions? Now, let's also discuss about the payoffs for buyer and seller of cap and floor. Cap option, floor option. Holder or buyer, there is a right to borrow. Here there is a right to invest, right? Let's say both of them are at 10%. For just the sake of simplicity, let's assume to be 10%. We call both of them as strike rates, right? At which the deal will happen in case it is supposed to happen. Let's say the premium in both the cases is 11%. Right? Now let's say case 1, the actual interest rate is, let's say, 12% in both the cases. Now students, come on, tell me, for a cap option, you have a right to borrow. Right to borrow at 10%, the market interest rate is 12%. What you will do? Will you execute the right to borrow? Will you execute the right to borrow at 10%? The answer is yes, because you can borrow at a lower rate. the market interest rate is higher. So that means you are gaining because of this option at the rate of 2%. You have a gain at the rate of 2%, right? So, gain slash loss in options, 2% there is a gain. And you have a right to invest at the rate of 10%, but in the market, you can invest at the rate of 12%. So, do you think it's a right anymore? Do you think it's a right anymore? The answer is no. Very good, Sanjay. So, there in this case, the option will not be executed, right? And hence, there will be 0% gain or loss because you will just go in the market and invest at the rate of 12%. But in both the cases, you have paid 1% as premium, which will be your sunk cost. This is already your sunk cost. So, basis this, you will not be deciding, right? So, whatever have you paid, that will not be relevant in your decision now, right? Now, the second case, let's say the actual interest rate is 8% and 8% both the cases. Then what will happen? Gain slash loss. Now, just understand, you have a right to borrow at 10%, and in the open market, you can borrow at 8%. Do you think this is an option or a right for me anymore? The answer is no, because I will just go in the market and borrow it at 8%. So, there will be 0% gain or loss. So, first of all, there cannot be any loss, right? In any of the situation, there cannot be any loss because maximum you will not earn anything, right? Either you will earn or you will not earn, but you will not lose anything. Now, if the actual rate is 8%, you have a right to invest at 10%. So that means because of this right, you are able to get 2% higher. So that becomes your gain. So that 2% becomes your gain. Okay. Simple. So this 2% becomes your gain. So the actual interest rate will actually define or will actually have a differences in the way the gain or loss is computed. Yes. Now, if you see students, let's come to question number 3. Okay. Question number 3, XYZ Limited borrows pound 15 million of 6 months SOFR plus 10%. So SOFR is secured overnight financing rate. Okay. So it's a variable rate, right? It's just like a market linked rate. Whatever happens in the market, that will keep on changing. But this is for the 6 months maturity period. Okay. So please do remember for 6 months maturity period, SOFR plus 10% for a period of 24 months. Okay. The company anticipates a rise in SOFR, hence, it proposes to buy a cap option from its bankers at the strike rate of 8%. Okay, so what is going to happen here, students? From XYZ Limited's perspective, one, borrowing 15 million pounds for SOFR plus 10%, right? So this is the spot rate at which the dealings will happen. Second, buy a cap option for this much of amount at the rate of 8% strike price. So whatever this SOFR is going to be, this will be actually compared to 8% for 15 million pounds. Clear? The lump sum premium is 1%. Okay, so what I was trying to say is, let's say SOFR is 6% plus 10%, so it will make the total interest at 16%. So I'm saying 16 will not be compared to 8. 6 will compare to 8, which is the strike price. The reason being, always if you see plus 10%, whatever is mentioned in the question, that is the spread, that will always be higher than 8, right? No bank will agree to give you a cap option at 8 for this combined value, right? So it is only for the SOFR. The lump sum premium is 1% for the entire reset periods, and the fixed rate of interest is 7% per annum. The actual position of SOFR during the forthcoming period is 1, 2, and 3. There are 3 reset periods: 9, 9.5, and 10%. You are required to show for how interest rate risk is hedged through cap option. For calculation, work out figures at each stage up to 4 decimal points and amount to nearest pound. It should be part of the working notes. So simple and easy, students. So first of all, what do we mean by reset periods? So reset periods are those periods, students, when the new rate of the SOFR will be coming into effect for the purpose of the calculation. So it will always be reset, right? So let's say today the SOFR is 10%. Now generally what banks does is, they will at every quarterly level, they will reset the interest rate. Now the next quarter, if let's say the actual interest rate moves to 11%, the banks also will reset it to 11% in the next period. Clear? So let's put down amount required. Pound 15 million. Cap option 8% against SOFR. Premium 1%. And the assumption is actually that there are 4 reset periods, right? Because it was for 24 months and 6 months is the period for the SOFR, right? So first of all, the total premium that we are supposed to pay is on 15 million pounds multiplied by 1%. So 150,000 pound is what we are going to pay for 4 reset period. Zero, 1, 2, 3, and then 4. 1,50,000 is what we are paying in the beginning. Can we calculate a EMI, or let's say the equal amounts in the balance 4 periods, which is all the 4 reset periods, right? Using 7% as fixed rate, 3.5% for half year reset periods, right? So what will happen here? 1,50,000 is equal to X divided by 1 plus 7% divided by 2 plus X divided by 1 plus 7% divided by 2 raised to the power 2. Right? For the first period, this was raised to the power 1 plus X divided by 1 plus 7% divided by 2 raised to the power 3 for the third reset period. And finally, for the fourth reset period, 1 plus 7% divided by 2 raised to the power 4 for the fourth reset period. So that means if we solve this, X comes out to be pound 4861. So this is the value of premium which is allocated to all the 4 reset periods. So if I want to say that after the first reset period of 6 months, 4861 is the value of the premium that will cost to you, right? So that 1% is broken down into different time periods basis amount. Clear? Now, using this, let's calculate the net payoffs. Calculation of net payoffs. Since in the question we have been given only details for 3 reset periods, let's take the 3 reset periods. Fourth one we can ignore it. 1. What is the SOFR rate? It's 9%. The cap rate is how much? It was 8%. So we have taken a cap option. Cap option is to borrow. Borrow is to take a long position. The rates has gone up from the 8%. So the person who is holding the cap option will gain. So the differential from bank will be 1% multiplied by 15 million into 6 by 12. That will be the net income of the option holder because the interest rates have gone up. So this comes out to be 75,000 students. From this, the premium that we have paid for this particular part will be 40, the EMI part of it, 4861. Not the EMI, but the equated amount. So the net payoff comes out to be 34,139 students. The second reset period, the amount goes out to be 9.5%. So the cap rate is again 8%. Here, the payout will be 1.5% of 15 million for 6 months. This is 1,12,500. Correct? Now, out of this 1,12,500, 4861 is the premium amount that we have paid. So the balance comes out to be 71,639. The last one is SOFR of 10%. Here we have 8% of the cap rate. So 2% multiplied by 15 million into 6 by 12 will be equal to 1,50,000. 4861 is going to be the premium. 109,139 is the differential amount from the premium. That is the gain amount. So the net cap option receipts will be 214,917. Okay. So this is the net cap option receipts. Now, if we have to see that for 15 million pounds, 9% plus 10%, this is the SOFR rate, right? For 6 by 12, this will be the first reset period overall payment. The second reset period will be 9.5% plus 10% into 6 by 12. The third reset period, 15 million into 10% plus 10% into 6 by 12. So this will, let's say, give you some X amount. From that, you will reduce the amount that you have received. Net cap receipts 214,917. So using this, you are able to actually, the extent by which the interest option have been hedged is this much. The extent by which interest option have been hedged is pound 214,917 for 3 reset periods. Okay. Any questions, students, till now? So this was a question on the interest rate options, specifically on the interest rate cap. So in a nutshell, students, what all have we studied in this? Forward rate agreements, interest rate futures, and interest rate options. So forward rate agreements is actually equivalent to the forward contracts. Interest rate futures is basically the futures. So this is from the derivatives that we have studied, right? And these are basically the options. In this, we have studied about two, cap and float. Here we have discussed about call and put. So both of them are very similar things, students. Now, forward rate agreements were over-the-counter agreements. Similarly, forward contracts in the derivatives also are over-the-counter agreements. Mostly they are settled in gross, right? But in case forward rate agreement needs to be settled in net, that option is also available basis that formula. Interest rate futures were traded on the stock exchange through bond futures. Similarly, the futures and the derivatives are also traded in the stock exchange. They are standardized with the standardized terms and conditions, with the standardized maturity, with the standardized lot size, right? But interest rate options are equivalent to the options, wherein the option holder has a right but not an obligation. So if the conditions are favorable, those will be executed. If not, then these will not be executed. Clear? Here it was to borrow. Here it was to invest the amount. Here it was to buy. And here it was to sell. And in both the cases, there is a premium applicability in both the cases. Clear? Perfect. Now let's move to question number 4. Two companies, ABC Limited and XYZ Limited, approach the DEF Bank for FRA, forward rate agreement. Now see, these are the OTC contracts, over the counter. That means these can be customized basis the requirement. They want to borrow a sum of rupees 100 crores after 2 years for a period of 1 year. So after 2 years is what they have to do, and for a period of 1 year. Come on, student, now tell me what FRA we are talking about. What FRA we are talking about? After 2 years, it has to start and it will continue for 1 year. So the starting point and the ending point, simple. Yes, very good, Leela. Very good, Sanjay. You are correct. So it is going to be 2 by 3. This is in years. And in months, if you want to specify, 24 by 36. This will be basis months. Clear? So this is the FRA that we are talking about. Bank has calculated the yield curve of both the companies as follows. For both ABC Limited and XYZ Limited, the yield curve is calculated. But can you see one observation? ABC is having a higher interest rate. Maybe ABC is having a low credit rating. The difference in the yield curve is due to the same point, the lower credit rating of ABC, because ABC would have done defaults earlier, or they don't have sufficient repayment capacity, and hence the risk of giving the loan to ABC is higher. You remember the previous discussion that we did in the beginning, and hence the bank would be charging ABC Limited interest also on a higher side. Clear? You are required to calculate the rate of interest DEF Bank would quote under 2 by 3 FRA using the company's yield information as quoted above. Now they are saying that calculate the rate of interest for FRA 2 by 3. Then the second part, suppose bank offers interest rate guarantee for a premium of 0.1% of the amount of the loan. You are required to calculate the interest payable by XYZ Limited, which is this company. If the interest rate in 2 years turns out to be, there are these two different cases that are given to us. Okay. So they are saying that the bank is offering interest rate guarantee at 0.1%. You are required to calculate the interest payable if at the end of 2 years, once the borrowing is actually starting, it turns out to be 4.5 or 5.5%. Clear? So first of all, we are talking about FRA 2 by 3. So let's talk about X, Y, Z limited first, right? If we have to calculate the FRA price 0, 2 year and 3 years. So 0 to 3 year, this is a 3 year rate that will be applicable. 0 to 2 year, it will be a 2 year rate. And then here duration is 1 year, but second to third year. So this is the FRA time period of 2 by 3 students, right? Now for XYZ Limited, what is the 3 year rate? 4.48%. Raised to the power 3, right? Now what is the 2 year rate? 4.2%. Multiplied by the 2 by 3 is X raised to the power 1. Right? So the X here is 5.04%. So FRA 2 by 3 for XYZ Limited is 5.04%. Clear? Then let's come to the second company, which is ABC Limited. Again, if we say 0, third, second, okay? So 0 to third for 3 years, the rate is 5.78. 0 to 2 years, the rate is 5.48. And this is the X percentage. So we'll have to calculate this as 1.1 plus 5 point raised to the power 3 is equal to 1 plus raised to the power 2 years, right? Multiplied by 1 plus X percentage raised to the power 1. Right? Because this is for 2 years, this is for 3 years, and this was for 1 year, students. Clear? So this will give us X is equal to 6.38%. So for FRA 2 by 3, for which company? ABC Limited, the bank would quote 6.38%. Here. Clear? Because the bank will always compare the different yield curves. and then finally arrive at what is the quote which will be applicable for the specific FRA in the question. So this thing is also evident that for XYZ Limited, the quote is at a lower side of 5.04%. But for ABC Limited, it is 6.38%. So if you see, because ABC is having lower credit rating, XYZ is having better credit rating. That's why ABC's yield curve is also higher, and even the FRA 2 by 3 is 6.38 percentage, and here it was 5.04 percentage, students. Okay, now let's come to the second part. Suppose the bank offers interest rate guarantee for a premium of 0.1% of the amount of the loan. You are required to calculate the interest payable only by XYZ. So we are not talking about ABC Limited here, only XYZ. If the interest rate in 2 years turns out to be 4.5 and 5.5. Now, first of all, students, interest rate guarantee. What will be the strike price? Premium, we know it's already 0.01 or 0.1%. 0.1%. 0.1% is the premium. Can anyone tell me what is the strike price? Strike price is not given in the question. Can we identify what is the strike price? How will bank determine the strike price? Okay. So Sanjay, I will take your question after this. But help me understand that what is the strike price? As of now, in the question, there is no strike price that has been given. Okay. So one interest rate we have calculated here, right? For XYZ Limited through the different yield curves. So the bank will also do the same thing, right? The bank will say that, okay, basis the yield curve of XYZ Limited for the differential period from second to third year, it's okay to charge 5.04% for the borrowing. So I will provide you the guarantee also at 5.04%. This will be called as the cap rate because this is the maximum rate. What is the notional amount, students, here? Have we given any notional amount? 100 crores. Right? These are the principal amounts. Will be 100 crores. Now, for both the cases, let's take 4.5% and 5.5%. Let's first compute what is going to be the actual interest amounts. 4.5% on 100 crores for 1 year, right? 4.5 crores. Here, 5.5% for 100 crores for 1 year, which is 5.5 crores. But this is actually wrong. Why? Because we have an interest rate guarantee in place. What does interest rate guarantee says that if actual interest rate is greater than 5.04%, then maximum interest would be 5.04% because it is capping the rates, right? So what we will do here, 5.04% into 100 crore into 1 year. This is because we have the interest rate guarantee from the bank or interest rate option from the bank. So it will be 5.04 crore. And in this case, since the actual interest rate is higher than 5.5%, so there are two ways to do this. One, we show that 5.5 we have paid, and the difference of 5.5 minus 5.04 we have recovered, right, from the option seller. So that is the one way to report, or straight away we can say that our net interest cost is 5.04%, which is the cap rate. Clear? Now against this, we will also put the premium. What is the premium? So premium was 0.1% for 100 crores on the entire value. So it will be 0.1 crores, and here also it will be 0.1 crore. So the overall number comes out to be 4.5 plus 0.1, which is 4.6 crores. And here it will be 5.04 plus 0.1, which is 5.14 crores. Clear? So this is the net interest. What was asked in the question? You are required to calculate the interest payable. Interest payable by XYZ Limited after 2 years will be, if the interest rate is 4.5%, 4.6 crores. Second, 5.5 interest rate if it is operating, then 5.14 crores. Now there is a very good question from Sanjay. I will take that up. So, okay, so the solution is over till here. Now I'm taking one question. So Sanjay is asking that we have been given 3 different years of maturity, right? The 3 different rates basis the maturity: 1 year, 2 year, and 3 year. So why have we? So we have used 0 to 3 year, 0 to 2 year. Both of them we have used. That means this one and this one we have used. But why can't we take directly this one? Because this is also for 1 year that we have been given. Okay, let me just specify here. So this one 0 to 1, then 0 to 2, and then last one is 0 to 3. Let me do one thing. Let me just make it a bigger line. So this is 0 to 2. Okay, so the question is saying that if it is 0 to 1 years starting from today, then the yield rate is 4.12%. I'm taking for ABC Limited. Okay, for 0 to 2, if we do, then it is 5.48%, and from 0 to 3, if we take, it is 5.78%. Now students, please note that for FRA 2 by 3, right, we have taken the total 3 years rate, and then we have taken the total 2 years rate from today, and then we have arrived at the second to third year rate for 1 year, right? This was for 1 year. Had we have to not start from second to third year, we could have used this 1 year rate. But since we have to start charging the interest after 2 years, so we cannot take this 1 year rate as of today, because this 1 year rate as of today is applicable from today. Okay, so hence we cannot take this 1 year rate which is applicable from today. We will have to compute what is applicable after 2 years, because that is when our contract will start, will get executed. Okay, Sanjay. So students, this brings us towards the end of today's session. So in today's session, students, we have covered asset liability method, forward trade agreements, interest rate futures, and interest rate guarantees. In the next session, we will be covering up the balance part. I request C. Ashish sir to please help with the concluding remarks. Thank
Thank
you.
you, Devas sir. Thanks a lot. Your session was very good and was also interactive. So, student, with this, we have covered the half portion of the interest rate risk management chapter. Now, this chapter is basically chapter number 12. Okay, so we can say that we are covering nearby covering the portion of risk management portion. So in the next class, we will cover up this topic. So meanwhile, if you have any query, you can contact us at the telephone number. Divasa, just share our telephone number.
Yes, sir.
0120 3045 956. And our email ID is sfm-final @ICAI.in. Okay, student, thank you very much for the patient listening, and thank you, Deva sir, for sparing your precious time and enlightening the student on this topic. Thank you very much.
Sir.
Have a nice day. Thank you.
Have a nice day. Thank you, sir. Thank you. Thank you, student.
Thank you. Thank you.
Thank you.